Hello, everyone, and thanks for joining. Very excited to kick off this session that we have here. My name is Dave Lovnick, VP of Business Development at YCharts. At YCharts, we're focused on providing a powerful and intuitive client communication, investment research, and analytical tool. We've had a long and great partnership with John Hancock, and we're excited to welcome two members of their team here today. Before we get started, let me remind everybody that this session is eligible for continuing education credit. You will receive an email with a link for that after the session. And also, I suggest that everybody take note of how to submit questions if you have any questions throughout the session. Let me kick it over to Jackson Fallon, Managing Director in the RA and Bank Trust Group.
Thanks, Dave, and good afternoon, everyone. My name is Jackson Fallon. I'm a Managing Director with John Hancock Investment Management. As Dave mentioned, I support our RA and family office relationships in the Central and West Coast regions. And I'd like to echo Dave's comments and thank you all for taking the time to join us. We've been longtime users of YCharts here at John Hancock. I personally use the platform every day, so we have had a great partnership over the years. Before I introduce today's presenter, I want to share just a quick overview of our platform at John Hancock. As some of you may know, we have a very unique structure and that we operate essentially as a manager of managers. We have a due diligence team based in Boston of about 200 folks that, like you, are tasked with going out and trying to identify institutional quality managers to sub-advise our mutual fund, SMA, ETF, and private market mandates. Currently, we partner with 21 unaffiliated managers, many of whom you're probably familiar with, names like Wellington Management, Bain Capital, and Boston Partners, to name a few. And aside from getting access to the investment capabilities of our sub-advisors, we're also able to tap into their collective research. And one way that we're able to harness that and put that together for our clients is through our market intelligence book. Market intelligence is a quarterly piece that essentially aggregates the views of not only our sub-advisors, but also our broker-dealer partners and research providers. And the goal is to provide a look through into what our network's views are on various asset classes. Now, this is forward-looking over the next 12 to 18 months, and by far, this is our most popular resource at John Hancock Investment Management. Today, we're lucky to have one of the creators of our market intelligence book with us, our co-chief investment strategist, Emily Rowland. You may recognize Emily from her appearances on Bloomberg and CNBC, but Emily leads the investment research function for us here at John Hancock. She and her team are responsible for leveraging capital markets and industry research to help set our product and business strategy. Emily joined John Hancock Investments in 2004 and has held a number of positions in product management, marketing, competitive intelligence, and other areas over the past decade. And prior to joining John Hancock, she held roles at GMO and the Boston Stock Exchange. Emily earned her MBA from Boston College and her BBA from James Madison and holds the CIMA designation. Emily, thank you very much for joining us today.
Thanks, Jackson, for the nice introduction, and to both Dave and Jackson and the rest of the team for helping put this event together today. I am so excited to be here with you. I've had a lot of fun really digging into YCharts. I think it's a great tool. What we did for this presentation was a fun exercise of trying to take a lot of the content in my flagship market outlook piece, which is called Market Intelligence, and actually put it into a YCharts framework. So we took our best shot at it with help from a number of folks from the team, and I'm looking forward to sharing this format with you in terms of talking about where we're finding opportunities and risks in the market today. So the way that we've structured this talk today is to divide it up into a conversation around the U.S. equity market. We'll talk about the macroeconomic backdrop. We'll talk about all the buzzwords around transitory and inflation, and all the key elements around what's driving markets today. We'll have a discussion on the non-US equity markets and some of the dynamics that are playing out there. And then we'll finally wrap it up with some thoughts on the fixed income market and where we're finding opportunities there. And then I'm really looking forward to taking any questions that you have. I know Jackson will be monitoring the Q&A. I think one great sort of side effect of now working and presenting in this format is that we can just keep the Q&A coming. We don't have to wait to, hit *6 and wait for your name to be announced. So I've had a lot of fun really getting into a Q&A over the last year or so. So let's start here by talking about the US equity market. And what you can see when you look at the right-hand side of the page is an illustration of where our views are over the next 12 to 18 months. And you can see that we are slightly overweight US equities. And there's really a couple of ways to think about that. One is we are slightly overweight equities versus bonds. And just think about this in the context of a 60-40 global balanced portfolio. And the idea there, frankly speaking, is that we do believe that equities are going to need to do more of the heavy lifting here, as return potential is incredibly low within the fixed income market. We do think that there are some ways to find or generate yield there, but it's getting more challenging. There are some strong fundamental support for stocks right now in the form of a new economic cycle emerging and earnings estimates, which continue to climb higher. So we are slightly bullish US equities. You can see here that we are overweight US large and mid-cap equities, and we are neutral small cap equities. So right now, what we want to do with a portfolio is we do want to rotate into areas that have more sensitivity to this new unfolding economic cycle. The challenge is it's happening fast. This is a cycle that is aging quickly. By the way, not an analogy I've really loved using as a woman in her 40s, but I think it's very appropriate for this market. We're aging fast. So we want to have exposure to areas like small cap equities. You can see we're neutral there, but they have run a long way fast. Small cap equities were up over 31% in the fourth quarter of last year alone, and they're up about 8.5% again year to date. Mid cap equities to us are really the sweet spot in terms of having that element of offense in a portfolio, again, to provide sensitivity to a growing economy. You can see here also that we are neutral growth versus value. Yes, you heard it here first. Growth and value can actually peacefully coexist in a portfolio, believe it or not. And the way that we think about this is it's really about positioning portfolios to capture the tail end of the early cycle, which is the phase that we think we're at now. We'll talk about that momentarily. And this beginning part of the mid-cycle. In early cycle environments, you want value. There's great catch-up potential in the value side of the house still. As you move through the cycle, though, you want to own the quality factor. Good return on equity, strong balance sheets, great earnings stability, and good fundamental businesses. The quality factor tends to show up the most on the growth side of the house. So for growth, we prefer, this is really an overweight to quality growth, not momentum. We've been underweight momentum. We're concerned about the valuations there. And we also want to own value, and within value, it's also quality value rather than looking more towards the dividend paying part of the value complex. So let's kind of take that conversation and talk a little bit about what's driving it. And the first thing that we always like to look at is where are we from an economic cycle standpoint? Now, I could show you 20 or 30 slides, and we had fun doing that when I worked with Dave and the others at YCharts. But I do think that the leading economic indicators that the conference board puts out is another great resource here. A lot of these underlying components can actually be found in YCharts. But to keep it simple, we like to use the LEI. And again, the conference board puts this out there around the 20th of every month, and it allows us to determine where are we in the economic cycle in the US. The 10 underlying components here of the LEI, you can see listed at the bottom of the page, and this is in order of their weight in the index. And essentially what you can see is that the leading indicators go from blue to green, or they accelerate coming out of recessions. So the recessions are these gray shaded areas here. On the other hand, the leading indicators, they tend to decelerate, or they go from green to blue, heading into a recessionary period. So when they're accelerating, these are typically opportunities for us to look at adding risk or beta to portfolios. And when the LEI is decelerating, these have typically been times where we've pruned risk within market intelligence. So what you see, this time around was a little bit different. The leading indicators really didn't give us a ton of warning. And a lot of that was because of the nature, of course, of this recession, which was driven by this global health pandemic. And what you saw was that the data plummeted in March and April of last year. And then since that time, we've seen huge upside surprises in economic data. So again, the worst of it back last April. And then really economists underestimated how quickly the economy and how strongly the economy would come back. I can blame the economists because I'm a market strategist. I'm kidding, because I can imagine how challenging it is to be making predictions on economic growth in such an uncertain and such an unusual time. So the strength in the economy wasn't totally surprising, given the massive amount of fiscal and monetary stimulus. So just to put that into context, we've done about $5.3 trillion of fiscal stimulus over the last year. Just in the first quarter, $3 trillion of fiscal stimulus was injected into the US economy. Now, when we take that as a whole, it's over 5 times the size of what we did after the global financial crisis. So massive stimulus, which is starting to show up in some different parts of the market. We'll talk a little bit in a minute about the inflationary impact, but also monetary policy. So the Fed has continued to pursue quantitative easing, purchasing $120 billion of treasuries and mortgage-backed securities each month. You know, the Fed's balance sheet, again, increased by about $300 billion just in the first quarter. So incredibly supportive growth, super easy financial conditions. In fact, probably some of the best economic data that we may ever see in our lifetimes. So we do certainly think that a new cycle is unfolding. The economy is accelerating. We finally got a huge positive print for the leading indicators for the month of March right here. I'm expecting another big one in the month of April, where the base effects, or the fact that we were in basically disinflation last year or recession last year, are going to flatter the year over year numbers when we receive them again in April. But there's no doubt about it. The US economy is on fire right now. And that's one reason that we have wanted to continue to embrace equities in this environment. Now, one of the ways that we're seeing that play out is this big rotation into more economically sensitive or cyclical parts of the market. And this is something that we expected. You know, when we looked at 2020, really it was all about growth and technology. In fact, the technology sector was up 44% last year in the US, and energy was down 34%. So we've seen a huge shift play out so far here in 2021. And the reason that we expected this to happen was because of the earnings backdrop. So what I'm showing on the right-hand side of the page are earnings growth estimates for 2021, and this is across the 11 sectors of the S&P 500, as well as 2022. What I'm not showing here is 2020. And what happened was that areas like energy and industrials and materials, they got crushed during the pandemic as demand completely fell off a cliff. And as basically industrial activity came to a halt. And what we expected was that those year over year earnings growth estimates would be significant in magnitude, especially versus technology that had a good year last year. So you can see that playing out in the price action. And I should have included industrials here on this page, as that's one of our favorite sectors for this market. And we've seen really phenomenal performance out of these areas, again, really since we saw proof that the vaccine was going to be effective back last fall. Strong performance here driven by these powerful earnings tailwinds. Now, we talked a little bit about this early cycle dynamic, and we talked about the cycle moving quickly. One of the other hallmarks of an early cycle environment is that you tend to see a significant appreciation in asset prices. So usually, even though we're still in a recession, the stock market, of course, is a discounting mechanism, and it starts to sniff out better growth and better earnings in the future. And that's certainly what we've seen. So the S&P 500 since March 23rd of last year is now up 85%. That's a pretty extraordinary, and I hate to use the word, but unprecedented return in the first year of a bull market. So the key question is, what happens next? So what we did to examine that is really look at history. That's usually the best way to try to figure out a playbook for what may happen next. And what we did is we looked back at the last 6 bear markets in the US. So we're showing the same data here on the left and the right, but essentially what you're looking at is the peak to trough decline. So what were the dates of the top of the market down to the bottom, what that total drawdown was. So you can see that we lost 34% in that quick little 4-week bear market that we experienced. And then what the returns are 1, 3, and 5 years out. And you can see the averages here at the bottom of the page. And the concept makes sense, right? Oftentimes returns, because the market's a discounting mechanism, are going to be pulled forward to the first part of a bull market. And that's what we saw here. You can see 1 year out at 75%. I mentioned 85. That's, of course, now we're through May. And there's really only one other example of returns that robust early in the cycle, which is post 2008, 2009 global financial crisis. So that's the orange line here. And this shows returns coming off the bottom on March 9th, 2009. And you can see this purple line is today. And it's pretty uncanny, actually, how closely we're tracking this example here. Now, I know it's never a great idea to use one historical example as the roadmap. I get that. But I do think it could give us some clues about how markets might behave, as we head into year 2 and 3 of the bull market. And what you can see is that there was a pretty meaningful period here of choppiness and consolidation in years 2 and 3 before equity markets finally found their footing here and climbed higher. So I think something to keep in mind here, we haven't experienced a lot of volatility. I think investors have been pretty quick here to buy the dip. But I do think that we need to remember that volatility is a normal sort of part of life. It's something that investors should be prepared to stomach here. But again, it's not a bearish message from me. What it means is that you've got to be more selective in terms of where you're finding opportunities. And I also believe it's an environment in which fundamentals, not just macroeconomic factors, are going to start to matter a lot more. I think you're going to see more differentiation between the winners and losers in the market as fundamentals come back into the spotlight. So expecting some choppiness here, but again, those fundamental supports being in place. So the key question is sort of how do you, position for this market? And what we've done here is we've shown our favorite sectors or our sector overweights kind of in light of those factors that I talked about early on in the presentation. So when we think about this rotation from the early to the middle part of the cycle, again, it's really about this combination of value and quality. Value for the early part of the cycle. Another thing you can do is go down in size and own small cap equities, which we talked about, kind of the unrelenting pace in that part of the market and that sort of being due for a breather. So value's our pick for early cycle, and then quality for that middle part of the cycle. So when we look across sectors, and the 11 sectors of the S&P 500 are shown on the right-hand side of your page here, along with their weighting, we look across areas like tech, communication services, healthcare, and industrials in terms of finding those opportunities today. So first, technology, and I want to acknowledge the fact that one of our top picks is the worst performing sector in the S&P 500 so far this year. And maybe just kind of a note about technology, because we have gotten a lot of questions about kind of the sell-off, if you can call it that, in the tech space. And I do think there's a few things going on here. Typically what happens when rates go up, which is what we really saw, especially here in the first quarter of this year, is that parts of the market that have lofty valuations, and in particular areas whose cash flows are expected to come far in the future or longer duration assets, they tend to get dinged when rates go up. And the reason for that is that their cash flows are now being discounted at a higher rate. So the present value becomes less attractive of those future cash flows. So I know we're kind of bringing out our finance textbooks here, but I think it's an important thing to think about. And that's one of the reasons that you've seen those particularly areas of technology with higher valuations and more distant cash flows in particular get burned as rates have gone higher. Now, the other thing that's happening is some more kind of idiosyncratic things. I would think of them as sort of paper cuts for technology, not big challenges here. Things like supply chain issues. So one thing to think about is particularly in the semiconductor space, which is sort of the poster child for this supply chain problem. If in case you don't know, there's major shortages of semiconductors. And if you can't build something, you can't make money on it. And I think that's one of the challenges that's impacting that part of the tech sector. You're also seeing tech potentially be or likely to be a relative loser under some of the Biden tax proposals that we're looking at. He's proposing that we go back from back to a worldwide taxation system from a territorial tax system. In other words, international profits are going to now be again included in that domestic tax base. That has a relative challenge to parts of the tech space as well as the biotech space. And then another one that I got from my colleague Dan Clifton over at Strategas, he did some analysis yesterday that suggested that tax receipts are up significantly, and essentially what his idea was potentially that investors were selling their winners in order to pay their tax bills. I haven't had a chance to ask my husband if there's something that he's doing along those lines in our situation, but I'd be curious to know. So there's some issues going on, kind of little idiosyncratic issues with technology. What it isn't is an earnings issue. And that's what I would be more fearful of. So I think if we did start to see earnings estimates rolling over for technology, we would be concerned they are continuing to climb higher. So we would be looking at any kind of reset in prices here as an opportunity to add to the technology space as we move forward. Communication services, another one of our sector overweights. This is really a combination of value and quality. When we look at some of the fundamental data, it's important to us, not only to look at attractive PE ratios, but also to think about how much you're paying for that earnings growth. And that's what the PEG ratio is going to give you. PE divided by earnings growth for earnings estimates, year-over-year earnings estimate growth. And basically the way you want to think about it is the lower the better. So it's kind of like golf, and communication services has among the lowest PEG ratios across all the sectors that we evaluate. Quality and value, also a combo that we find in the healthcare sector. We see some great quality metrics in healthcare, great return on equity. It is trading at a significant discount to the broader market. I do think this is a function of some of the bad news from a political standpoint, potentially being priced into healthcare, things like prescription drug pricing and changes to Medicare. So some pretty, significant potential changes kind of providing downside pressure on healthcare. We do think that there is a great fundamental case to own that sector. We like the earnings growth potential, so we're overweight there. And then finally, industrials. This is really our pure value play. It's a sector that can do well in post-recessionary environments. It actually is a value sector that doesn't need a necessarily higher rates in order to show market leadership. So this is an area that we've been emphasizing as well. Mid-cap stocks. I mentioned this is our pick in terms of having some offense in a U.S. equity portfolio. And the reason for that is mid-cap equities tend to show a nice bounce coming out of recessions. And that's what we've highlighted here using YCharts data. So what we're doing here is we're showing the Russell mid-cap and the S&P 500 in the first 2 years of a bull market. So the top two lines are the 2008, 2009 recovery that started in March of 09. And then the bottom two lines are the recovery in the early 2000s, starting in October of 2002. And I wanted to show the entire 2 years to show you that that initial bounce actually continues into year two, which is obviously the part of the bull market that we're entering now. So what you can see is that mid-cap sees an initial pop. It continues to outperform significantly in both periods, the purple line being above the orange line in both periods. There's a lot of different ways to show this data, but one reason for this pop or this bounce is because of relative sector composition. So if you look on the right-hand side of the page, what we're showing is mid-cap sector weights versus their large cap counterparts. So if it's on the right-hand side of the page, it's a mid-cap overweight. And if it's on the left-hand side of the table here, it is a underweight. And essentially you can see that the industrial sector has the largest overweight within mid-caps. This is helping, by the way. Mid-caps are the best performing part of the cap spectrum so far year to date. And we like industrials for the reasons I mentioned earlier. We also like going down in market cap in industrials. So while you're going to get more exposure to the larger conglomerates up in cap, mid cap, you're really getting that sensitivity to the investment that's being made as we emerge from the recession. Think about things like building materials and trucking and other parts that may be sensitive to infrastructure spending or other investment that's being made here as we move into this recovery phase. So the overweight to industrials is something that we really like within the mid-cap space. So let's transition here along to international equities. And the first thing that you'll notice here, we have a similar illustration that we had for the US equity market, is that we have been underweight international developed. So think about this again in the context of the decision between US and non-US equities. We've had a preference for the US. And really our thesis has been that the better and more robust economic recovery that we've seen in the US, the more robust earnings recovery that we've seen in the US should benefit US equity prices over international equity prices. And that's been the case. US has outperformed non-US developed year to date, but that's been shifting a little bit, as we'll show on the next page. And we'll talk a little bit about the reasons for that. Emerging market equities has been an overweight for us. When we look at economic growth prospects, it's really the US and emerging markets that are growing the fastest. And emerging markets are showing of the best earnings estimates as well for 2021. Now, when we look at what's happening year to date and over the longer term in the US market versus non-US developed, you can notice a couple of interesting things playing out here. First of all, year to date. So this is a YCharts chart, obviously, on the left. And what you're looking at here is year to date performance of the S&P 500 versus the MSCI EAFE. And what you can see as of late, and if I drew this again, I think we did this on Monday, the last couple of days we've seen Europe outperform. It's catching up pretty nicely to the US and having a nice rebound here. And there's been a couple of reasons for that. One is we have seen a weaker dollar environment. So the dollar is weakening significantly here. That has provided a tailwind to non-US developed performance. We've also just seen this, huge sort of cyclical surge, and we've seen it across areas like commodities as well. And again, when we look at relative sector composition, you do get a lot of exposure to materials and energy in EAFE, and particularly in Europe as well. So we're seeing that happen. We're also seeing economic data, even though it's not quite as good as it is in the US, it's actually been surprising on the upside. Now, in the US, that's pretty hard to do now. It's kind of like a high jump competition where the bar just keeps getting higher and higher and higher, and there's no way to continue to kind of surprise or delight the market on the upside. And that's not the case. Expectations were more depressed in Europe, and we've seen some of those estimates overcome or beaten overseas. And so that's also provided a bid. So it's been really this kind of strong cyclical recovery, the weaker dollar, and there has been some momentum here for Europe and EFA broadly. Japan is still not working. And if you look over the last 10 years, clearly it's paid to have an overweight to the US versus non-US developed. And in fact, in the 6 years that we've been publishing market intelligence, we've largely been overweight the US. And really the reason for that is we have had a much more attractive earnings environment here. Some of that does, again, have to do with sector composition. When you buy US equities, you're basically buying like a giant tech ETF. You own a lot of technology. The technology sector only represents about 7% of the MSCI EFA. What you're going to get there is a big overweight to financials, European banks. And when we look at the European economy, it's really struggled over the last 10 years to generate any type of meaningful growth, to generate inflationary pressures. There have been a series of kind of recessionary environments there, and it's pretty amazing. There is a double dip recession happening in Europe right now, and their market's going up. It's a little bit confounding. So over time, we've had a preference for the US. I think this is really a key reason why you want to have tracking error in your international developed exposure. You want to have an active manager. You want to have the ability or a strategic beta product. You want to have the ability to be thoughtful about where you're allocating assets internationally. To us, we do have a preference for international growth over international value. That's going to get you more exposure to that quality factor that we talked about and away from that overweight to financials that you tend to see in international value. The other idea here is just around currency markets. This is always a big wild card in terms of really dissecting and understanding the relative performance of US versus non-US equities. So here at YCharts suggestion, I found a new dollar index I wasn't as familiar with. We're showing the Deutsche Bank US dollar index here in the purple versus its 50-day moving average here in the orange. And you see that we had this significant weak dollar environment playing out, starting in March 23rd of last year, major dollar weakening, risk on environment. To start the year, we actually had suggested that we might see an upside move in the dollar. Again, typically this is a relative economic growth story. If the US is growing faster than the rest of the world, that should create a bid for US dollars. And that's what happened in the first part of the year. Again, that's reversing a little bit as those economic upside surprises continue to play out in Europe. So we've seen this weaker dollar really benefit the performance of non-US equities. This is something that we want to be aware of. This is a risk to not owning international developed and emerging market equities. So that's a reason we want to continue to have an allocation there. If the dollar does continue to weaken here, you could expect to see continued outperformance from those parts of the market. So we would still suggest owning them. But again, we do think as we return to a more normal economic environment, this is a very unusual one in which commodities are surging, inflation's picking up, that's causing a weaker dollar. When we return to a more normal environment, again, you're going to want to have allocations to quality, and you're going to want to be very thoughtful about how you're allocating to international equities. So quality over growth, quality and growth over value internationally. So let's spend our last couple of minutes here before we turn it over to any questions that have come through, talking about fixed income, talking about inflation, and kind of sorting through what that means for portfolios. So in case you missed it, or I guess in case you're living under a rock, whatever it may be, or you went on vacation, something, we just got a massive inflationary print. It came in at 0.9%. Core CPI was 0.9% month over month. for April. That's the highest level since 1983. And then core CPI came in at 3% year over year. So this is my chart of inflation. We have core PCE. This is the Fed's preferred measure of inflation. It'll be updated to reflect those higher CPI numbers. It's just a little bit more delayed, but they track pretty closely together. So we're seeing it. And in our view, we are in the eye of the storm as far as inflationary pressures go. And what you have going on is basically this perfect storm of supply chain constraints, or basically suppliers cannot meet the demand from consumers. Manufacturers can't get online fast enough. They can't hire people fast enough to keep up. And then, of course, surging demand as we emerge from the pandemic. And on top of it, we have this huge amount of fiscal stimulus, particularly that flattered investors' wallets in the month of April. So you have surging demand, you have limited supply. When we look at the inflationary sort of underlying components, the biggest ones actually haven't risen that much. Healthcare and rent or shelter really has ticked up only modestly. We've seen it more in areas like used cars. That was up 10% month over month. Areas like airfares, hotels, as people get out and start to travel again. So essentially what the Fed has said is that they believe that inflation is transitory. In other words, they think it's going to pass and that we'll return to a more modest environment after the next, well, they won't define the period, likely the next several months. So there's one other thing actually going on, which is base effects. So when you look at the year over year numbers, you got to remember that a year ago, we were essentially in disinflation. So the numbers or the prints that we're getting today are being flattered by the fact that we were in disinflation last year. So they look a lot bigger. So the Fed's acknowledged this. They've said that they think that inflation is going to be transitory. We do tend to agree. And we don't know how long this is going to last. It's hard to say. We're writing the textbooks basically as we go. But our thought is that there are some secular forces that we think have really, or we know that have been in place for a long time that we think are going to reassert themselves again. So it's really around advances in technology and digitization and globalization. Think about things like the Amazon effect. We now have complete price transparency on everything that we buy, right? So that's wildly disinflationary. And there's a lot of other developments around tech and digitization that have really increased productivity and kept a lid on inflationary pressures. And we do think that those elements reassert themselves again. There's still a ton of slack in the labor market. The labor market is healing. We did get a very disappointing jobs report last Friday. Maybe it's an anomaly. We don't know yet. But there's still a lot of about 7.5, 8 million Americans who had jobs a year ago who don't have them today. So something to consider here as we move forward in terms of impact to the market. So it's been a little bit surprising, even given this huge inflation print, that we actually didn't see the 10-year Treasury moving up that much. It moved up, but the biggest move that we saw actually took place over the course of the first quarter. So markets anticipated this. And again, we know that markets are anticipatory, whether it's stocks or bonds. So the market's been speculating essentially that we'd get more growth, we'd get higher inflation. And they've been betting on this and essentially saying, we think that the Fed's going to have to deal with this sooner than they're telling us. So if you look at the Fed's dot plot, if you look at their statement of projections, which comes out quarterly, the Fed has told us that they're not going anywhere. They've said that they are not going to raise rates anytime through 2023. They've said that they're not even thinking about raising rates or thinking about tapering. But the bond market's kind of calling them out on that and saying, we think that you're going to move sooner. If you look at euro dollar futures, they are pricing in one rate hike in 2022 and then 3 more in 2023. So that's, very different story than what the Fed is saying. And the reason that that's important to a portfolio is if you want to be positioned for higher rates, you have to bet that even more growth in inflation and even more Fed rate hikes than 4 in the next 2 years are going to happen in order to benefit from that positioning or to benefit from significantly shortening duration. And we're essentially taking the other side of that, bet, if you will, and we want to continue to embrace duration, and we want to continue to own bonds that act like bonds. So treasuries and mortgage-backed securities and investment-grade corporate bonds. The challenge, of course, is that return potential and yield are incredibly low. So when we look across the bond market, which is what we're doing here on this page, it's really about being selective. And you look at areas like the 1-month treasury rate yielding basically 0. You look at, we don't have this on here, but the aggregate bond index yielding 1.6%. We want that because we don't want to abandon high quality bonds. We want to own them as a buffer against risk. We want to own them as a dampener, as a diversifier, but it's just not going to cut it in terms of generating return for clients. So we have to be more thoughtful about that. Now, one thing we could do is we could go to the CCC high yield bond market and get 7% yield. We don't want to go over our skis in terms of taking risk like that. In fact, what we've done in our views in market intelligence is we've really gravitated towards the lower rungs of the investment grade corporate bond area. So we're looking at things like BBBs as a part of a core portfolio, and then looking at some of the higher quality parts of the high yield bond market. So specifically single B or double Bs or fallen angels that have the ability, again, to be upgraded to investment grade. We've also looked at a small allocation to bank loans in order to look for some additional yield while bringing the duration of our portfolio down just a bit to lower than our benchmark. So really what we're targeting within a fixed income portfolio is looking to manage duration or shorten duration slightly lower than the benchmark, around 5 years of duration, but also to generate a yield of around 3%. So it's not an exciting kind of opportunity set. I don't think the fundamentals aren't screaming at us. We don't love duration. We don't love credit. But I think a combination of the two should help us meet that objective of about a 3% yield. Bonds are boring right now. They should be boring in a portfolio, in my opinion. And I think as a combination of a 60-40 portfolio, we want to see equities do a little bit more here of the heavy lifting. But again, we think the 60-40 portfolio is alive and well, and we do still want to own bonds. So just to wrap it up before we take any questions, we're at around 2:45 here. In terms of portfolio ideas, again, as we emerge from the late stages of the early cycle, we start to enter the late mid cycle. We are aging rapidly. We want to look to quality and value for portfolios to play this environment. In terms of having more sensitivity to the unfolding cycle, to this post-recessionary environment, we want to look to mid caps as the sweet spot, that element of offense in a portfolio. And then finally, within credit, we need to find ways to overcome inflation. We do not think this is the right time to significantly shorten duration. We don't think this is a great time to be an ultra short or bond funds or cash or money market funds. You've got to do more to generate yield, but you also want to be really careful about how you do that. So looking at a combination of BB, BBB, and bank loans, I think is an appropriate way to get there in terms of that credit bucket. So I will leave it there. I'm more than happy to address anything that's come up as we've moved through the presentation here today, and I'll let Jackson sort of take over the presentation from here.
Yeah, thanks so much, Emily. Really appreciate your insights. And just a reminder to the audience, feel free to submit questions using the Q&A function below. We do have a few that have come in, so I'll start right off, Emily. First one on multiple expansion. Do you have any insight on multiple expansion? Do you think current multiples will persist, or will we see downward pressure?
Great question. So 2020 was the year of multiple expansion. So we had about a 13%, negative 13% earnings growth back in 2020, and we had markets up. So what that means is all of it came from multiple expansion. Not totally atypical, again, of that early cycle appreciation you tend to see in assets, but this year is the year of earnings growth. So our view is that multiple expansions behind us, and now the earnings engine really needs to kick into gear. In fact, you already have seen a little bit of a reset in multiple expansion. The S&P 500 was trading at around 22 times forward earnings for really a good part of almost a year. And now we're down to about 21 as we've seen prices reset a little bit here and earnings continue to do well. So the earnings engine is kicking into gear. And again, I think that really brings the importance of fundamentals into the spotlight. And we're going to be looking closer at companies' balance sheets. We're going to be looking closer at companies who can be profitable and maintain margins as we move into this stage of the cycle. And I think it's going to be important that fundamentals can start to drive markets here. Thanks for that question.
Great. Love this next one. I was living in San Francisco and this topic came up every single day, and it's of course all over the news now, but thoughts on cryptocurrencies. How do you think about it? Does it fit in a client portfolio? How is that affecting the markets and our views?
Yeah, so certainly a very important topic. You know that there are some kind of pockets of speculation in the market when there's this intersection with popular culture and investing. So I think, Elon Musk kind of hosting Saturday Night Live. I would say the fact that my 11-year-old son, who's in 5th grade, asked me about cryptocurrency and which cryptos he should purchase every single day. He wants to use his first communion money to invest in cryptocurrency. I would say it's extremely volatile. It's extremely hard to really sort of understand what exactly drives it. When we look at an investment, we want to understand what are the fundamental drivers. How can I evaluate it? How can I determine where the relative opportunities in the space are? And so far, the only thing I can really understand is that it's driven by sentiment, and that's not enough for me. So we have technical strategists that will use charts to try to determine the direction of it. And that's fine. That's a little bit shorter term. So we see it more as a sort of tactical trading vehicle. And that's not something that we would take a view on than a fundamental holding. So the bottom line really is that we prefer more traditional assets.
Next, as we anticipate inflation, what are your views on tips?
Yeah, so I think, tips can be an appropriate addition to a portfolio as inflationary pressures build. A lot of that is priced in. And the other thing to remember is that the underlying vehicle of tips is, you guessed it, treasuries, right? So you have to think about some of the duration risk that you're going to take on by embracing treasuries in this market. So we're underweight treasuries. We had been overweight for a couple of years. We had a great couple of years of returns. Treasuries were up about 7% last year. We took a little bit of that off this year as return potential went down. And I would suggest that, tips would essentially fall into that same category for us. One of the best ways to think about inflation protection is simply by owning equities. Equities tend to do well in inflationary environments. Value in particular, as inflation picks up, can be a great hedge against that. So we believe that as we enter the eye of the storm from an inflation standpoint, the best way to sort of protect yourself is by owning U.S. value companies.
Great. Next question. Are you assuming that we don't see any more COVID-related lockdowns given the vaccine situation, or is that still a risk for the economy?
I can't answer that question with full certainty because it's hard for me to use COVID as an input. I'm not an epidemiologist. I'm not an expert in it. I would assume, I think that here in the US, we are on the other side of it, broadly speaking. And even if that we do get a surge or some other variant that comes to the US, of course, vaccinations will help. But we've also figured out how to live with COVID in some ways, whether it's mask wearing, whether it's social distancing, whether it's figuring out how to send our kids to school. Thank you for that one. Those are all kind of norms that we've developed over the last year or so. So I think that it maybe would be a challenge here. Certainly the UK today is starting to look at it as some of the India variants are coming there. They're starting to look at renewed lockdowns, but I don't think that it would stifle the economy the same way that it did back in 2020.
Great. Next, with such a strong economy, why do you feel strongly about avoiding or having limited exposure to shorter duration, high yield markets?
So, I think the challenge, shorter duration, high yields, a little bit of a different question there. I think that, you've got to just be careful here about risk management. The fundamentals within the high yield bond space don't look overly compelling. Investors are being compensated the least amount for holding high yield bonds than they have in over a decade right now. So spreads have come in, the Fed sort of, providing cover here, insisting that liquidity is here to stay for some time, has caused the fundamentals in the space just to not look all that attractive. So I think it is important to look carefully at high yield. Again, focusing on those sort of upper tranches of the credit spectrum within the space. I think that the continued economic recovery should bode well for the credit market. I just don't love the fundamentals there.
I know you discussed the fact that both growth and value can live harmoniously in a portfolio. I like this question. How long do you see value outperforming growth?
So I think value is a rental and not a buy. Growth has really dominated over the last number of years. And the reason for that is because we've been in a low growth, low inflation, low rate world for the last 10 or 15 years. And the reason that has benefited growth over value is growth tends to be comprised of companies that can grow organically, regardless of what the economic growth backdrop looks like. We can be expanding, we can be declining as far as the economic backdrop goes, and growth companies can have the ability to maintain profitability. Value in general needs higher rates, it needs inflation, and it needs really kind of resounding economic growth to show market leadership. I'm not saying value is going to disappoint in a big way starting later this year. I just think it's hard to see value maintaining this level of leadership because my view is that we've returned to a more kind of quote unquote normal world once we get past this inflationary episode here over the next couple of months. So I'd give value. Definitely, I think it's a great place to be right now. I'd give it a few more months here. But I do think as we edge into the back half of the year and enter this mid-cycle environment, I do think that growth should catch a bid there.
Great. I think we have time for one or two more here. So this one is, how do you think about real estate? The economy's coming back, but will people still work from home? I'll combine this with another one too. How do we think about the housing market? I think for anyone that's been looking to buy or sell their home recently has probably noticed just the lack of inventory and crazy bidding wars. How does that all factor into our outlook?
Yeah, so the real estate questions are really interesting one. And just starting with your second question around housing, one of the big supports obviously has been super low mortgage rates, but also kind of bringing it back to the kind of perfect storm. At the same time, there's been very, very limited inventory. And then folks kind of fleeing cities and moving to places where they have more space as a result of COVID. So there's been a significant, of course, increase in housing prices. The lumber shortage certainly isn't helping things in terms of new home construction. Prices are going up there. But as rates creep up here, affordability, and I know a lot of people on the call are feeling this, is going to become a challenge. And that could start to create pressure as far as demand goes. So these supply and demand dynamics within the housing market, I think, may start to come together a little bit more here as we head forward, particularly as mortgage rates go up over time. And that's something that the Fed is watching closely. As far as things like commercial real estate, kind of a double-edged sword. I think, work from home trends are still kind of being played out. It looks like most companies are going to go to some type of a hybrid role. I mean, I think all of us have figured out a way to gain a lot of efficiencies in working from home. All you got to do is slap a little background behind you, throw a tie on. Jackson's got a tie on for the first time in a year. And there you go. Right. So I think, some of the commercial real estate in cities is going to be impacted by that. And we'll have to wait and see sort of how that plays out. But again, with mortgage rates being still low, I think there's also an opportunity as far as kind of investment in that space as well. So some kind of competing dynamics here that are impacting commercial real estate, broadly speaking.
Great. Well, I know we're short on time. There are some other outstanding questions, but we'd encourage anyone that does want to pick Emily's brain further to reach out. We'd be happy to connect and follow up offline. But with that, maybe I'll pass it over to you, Dave.
Yeah, thanks, Jackson. And thank you very much, Emily, for the insights. That was very entertaining, very educational. It's easy to see why you're so popular on TV. So thank you for your time. I just wanted to mention, everybody, that if you would like to sign up for the John Hancock Market Intelligence booklet, you can do so through their website. The link is on the screen right now. I encourage you to do that. And also, for anybody out there that is not currently a client of YCharts, we are running a special promotion through the end of this month for new clients to receive a small discount in the name of this John Hancock webinar. You can visit sales@ycharts.com for that. Thank you very much for your time. Thank you, Jackson. Thank you, Emily, and have a great rest of the day.